Welcome to another episode of Diversitas. Diversitas is a podcast at the crossroads of diversity, business, and culture. Here for our February 23 episode, Black History Month episode, is James Sanders. James is the Senior Vice President for Commercial Lending for Univest Bank, but he is so much more than that. James has distinguished himself not only through his career in banking, but he has, importantly to this conversation, really been at the forefront of the battle to provide diverse businesses in the Philadelphia region with greater access to capital. From his earlier work with the Minority Business Development Agency to his current position, James has been consistently and relentlessly intentional about identifying opportunities for diverse businesses. So we'd like to get his perspective today on the state of diverse business, particularly in our region, and what diverse businesses can or should be doing to get access to capital in today's market environment. So with that introduction, welcome, James. Very nice for you to come on today.
Mike, good morning. Thank you for inviting me to be a guest on the Diversitas podcast. I am super excited to begin the show and to answer some great questions and provide some sort of, background on myself as well as context for the marketplace and what's happening here today. So thanks again.
Well, the beauty about having you on, James, is you are an excellent communicator. So all I need to do is say boo and you start going. So that's
yeah.
So for the uninitiated, tell us what is Univest Bank. I know what Univest Bank is, but tell others in our audience what it is.
Yeah, so Univest Bank is a community bank based in the greater Philadelphia region. It started out in Souderton, Pennsylvania. That's Montgomery County, Pennsylvania. Montgomery County is the third largest county in Pennsylvania. Univest was started about 147 years ago through several acquisitions over the last, I would say, 3 to 4 years. The company has grown. They're about $6 billion of assets under management. While that may sound like a large dollar amount, it is a community bank. Community banks are typically under $10 billion assets under management. Once you get over 10, then it's like 10 billion, it's like 11 billion to about 100. Then you're in a middle market or a mid-sized bank. And then, sort of 100 billion to infinity, trillions. You are now a large bank like the, Wells Fargo's, Bank of America's,
right.
JP Morgan, exactly right. So yeah, we are a full service community bank. What does that mean? Some of the names that I just mentioned, the Bank of America's, JP Morgan's, Wells, things of that nature. We have some similar divisions, right? And those divisions are wealth management, right? A full service wealth management division, a full service retail bank division with consumer products, right? Like commercial mortgage or banking, residential mortgages, credit cards, deposit accounts. We also have a commercial banking division that has a small business unit, middle market business banking unit. We have a legal lending limit of about $100 million. We also do SBA financing. Then we do asset-based lending as well as accounts receivable financing. And then there's an insurance division. Mm-hmm. It's very rare that you can go to a community bank to find all of those sort of business units under one umbrella. Typically, a community bank is one-sided, maybe two, right? That they aren't multidimensional. And typically, they're either a consumer bank or a commercial bank. And then they'll have partners to do wealth management, partners to do insurance. Univest has all of those organizations as a part of the Univest Financial Corporation.
Right. So would, for example, another bank, like a bank that's been making news here locally, Republic Bank, is what designation would Republic have? Is that a mid-market bank or is that a community bank? What is it?
They sort of teeter around community / mid-market. They're a little above community bank size, but they act like a community bank because they were founded here and most of their presence is here. but their footprint where they do business may be a little broader. Right?
Okay.
So community banks have a specific footprint. Typically, to kind of keep it simple, a community bank says if we can drive to our client within an hour and a half to 2 hours, that's where we do business.
Got it.
Right. And so you think about Univest being located in the greater Philadelphia region, or let's call it Philly, Montgomery County. Right. So we do business in New Jersey, the entire Commonwealth of Pennsylvania. We recently expanded to Pittsburgh, Delaware, as well as Maryland. We just opened up a Baltimore office with a market president there, as well as a market president in the Pittsburgh area. So a year ago, we were not, we were kind of doing business in Pittsburgh and Delaware, and I'm sorry, in Baltimore. When I say kind of, like, you know, if you were doing business here with us and you decided to make an acquisition or grow a little farther down, either in the Maryland area or in Pittsburgh, then yes, we would do business with you because you are a familiar client. But if it was a new client at that time, the answer was no. But at this point, we now, you know, we're opening offices there. Some branches are going to be opened up. So now we actually have a physical footprint as well as talent in that location.
So so when you opened the office in Pittsburgh, I mean, you didn't do that through Univest didn't do that through acquisition. It did that through kind of organic growth.
Yeah, organic growth. Hired some talent up there, market president who has over 28, close to 30 years of leadership in banking in that region. Typically, those individuals come from, you know, very reputable banks with a portfolio of clients and name recognition in the marketplace, as well as the same thing down the Baltimore area. So Univest is committed to sort of organic growth. One of the reasons I transitioned during the pandemic from my former bank to come to Univest was that they were sort of at the lower or middle end of community bank size, right? So there was an opportunity to grow. They weren't sort of getting to that ceiling. When you get to that ceiling of that 10 million, there's some internal things financially that have to change, and profitability adjustments and things of that nature. So you either, you know, kind of continue to be small or community bank, or you sort of catapult past it, right? Because it costs more, the cost of doing business, it changes when you surpass that 10 billion range.
Univest isn't on any exchange though, right? It's not a public bank. Oh, you are?
Publicly traded.
Okay. How
on
long?
the NASDAQ. I got to check back. I think we've been publicly traded for about 11 years.
Okay.
Yeah, we are publicly traded.
So, you know, it's interesting that you know, two things came to my mind just about the banking industry in general. First of all, when you go into Pittsburgh, you know, and you kind of said this already, but it's like, yeah, you're not acquiring another bank, but you're going into that market and you're really acquiring people from other banks, right? People who have books of business, people who are able to kind of jumpstart the bank's presence in that particular area. Isn't that how you do it organically?
Yes. That's very politically correct. I would also, you know, I can use another term, and I mean this from a business perspective. So giving some pre-context on that, the financial services industry across the board is very incestuous, right?
Yes.
They sort of, folks move from one place. When I say
that was my next point.
Yeah.
There's a lot of, it seems to me that there's a lot of moving around in the banking industry. Is that because when I was growing up, like somebody stayed at a bank for like, you know, 20, 25 years, 30 years. Now it does seem like there's a lot of moving around in the banking industry, particularly in kind of the mid-level jobs.
That's correct. Yeah. So it's people move with people, right?
Yes.
Or people move because of opportunities.
Right.
So in that order, right? Like if you have worked with an awesome leader and you or the bank was sold, right? Like I moved from a bank because there was a merger, then there was overlap in divisions, and eventually there was going to be some downsizing. Again, I'm an econ guy, so I understand that. So I make decisions before decisions are made for me, right? Or if they don't communicate otherwise. And so I've done those things in the past. And so you move on, but I still have friends now at some of these organizations that I worked with, 20 plus years ago.
Right.
Right. And when
Right.
those individuals move, they'll give a call like, hey, just moved over here looking to build a team.
Right.
Love to have a conversation with you. That's how it
Right.
happens. Right. And then
Yes.
people go from one place to the other, and grow. And so you find that typically there are teams of individuals that know each other, and they've known each other for a very
For
long
years.
time.
That it seems like that's um especially true in the commercial lending space. Is that it's I know over the years as I've read the Philadelphia Business Journal and this and that, there's always like a team of lenders that are going from one bank to another bank, and it's not just like one person. They're taking like 5 or 6 people with him or her.
That's absolutely correct. Right. And because of the title of your podcast and your company, right, Diversitas, I'm going to talk about the diversity part of that. Right.
Yes.
So when those groups of individuals typically are moving from one organization to the other, what I've seen and experienced is that there's been minimal diversity in those groups of people.
Yes.
Whether, when I say people, humans, no matter what the gender or
Right.
ethnicity, it typically they're not ethnic individuals, right? In large part in those groups. I'm not saying it doesn't exist.
Right.
I'm saying the number is minimal, right? But I think some of that is because of the lack of sort of knowledge regarding the opportunities in banking, right? Because there's many tiers. There's small business, SBA, commercial, and so forth.
Let's talk about that. So first of all, let's talk about your story. So what was your path to becoming a senior VP of commercial lending? Like, how did you get from there to here?
Yeah, good stuff. In your introduction, thank you for providing that introduction. And I'm glad that we know each other, that you sort of know that my value proposition to the marketplace is not just being a banker.
Right.
Right. Because to me, and this is not disparaging any other bankers, the value add that I intentionally developed over the years is to be more than just a banker. Mm-hmm. Right. And so I'll say why, but then how I got to this point. My experience is sort of a mix between financial services. I started off in investment management for large wealth management firms, the Vanguards of the world, the American Express Financial Advisors, which is now Ameriprise, and sort of moved through the stream, had my investment licenses and things of that nature, securities licenses. And I, at one point, got into financial planning for myself, and moved out of financial planning and moved into banking. And I was a private banker. So at that point, I was more of a hybrid, right? I had investment licenses, and I was also working with small businesses as retail folks. And that allowed me to work with individuals, businesses, as well as their families, for investing, along with work doing commercial financing, insurance, because I have property and casualty insurance license, as well as life insurance. So I was sort of looking at a holistic approach. Where did all that come from? Well, growing up in deep poverty, I had a goal and mission to eradicate poverty. Mm. Now, as the famous rapper, Shawn, aka Jay-Z, said, I didn't figure this out until after I graduated school, by the way, and probably 10 years into my career. I really just wanted to take care of the world I knew, right? So eradicating poverty is a big deal, right? With billions of people in the world. And my professor in my senior year said, that's going to be hard to do. And in my mind, I looked him dead in the eye and said, but I want to do it, right? And so long story short, I learned that wealth creation was part of that. So through a series of moves from financial services to different levels of financial services, and then economic development, and my tenure with the Enterprise Center as a sort of quasi-governmental employee with the U.S. Department of Commerce Minority Business Development Agency, that catapulted my value add to the marketplace by really being fully immersed working with minority businesses at all levels, excluding startups, to help them with access to capital, whether that be bonding, debt, equity, penetrating the supply chain of private sector, public sector, and to help those firms grow vis-a-vis organic or acquisition or strategic partnerships, JVs, mentor proteges, and so forth.
Man, you're talking my language right now. So this is.
Yeah. So the value proposition that you see and have and learn and understand now was developed over the years of, when I use a football analogy, being in the trenches, doing the work and understanding the hurdles and challenges, talking to the procurement managers, procurement directors of the Mercks of the world, J&J, of Comcast of the world, U.S. Department of Defense, I mean, billions of dollars being spent, and understanding what the challenges are and how to work with. I don't want to use that.
Let me ask you this, James. When you were doing that work with the Enterprise Center, what, in your opinion, were the 3 largest impediments to diverse businesses getting access to capital?
So the 3 largest impediments, not really understanding, so I'm going to synthesize it. Barriers to entry in the supply chain of the organization, right? Because those barriers to entry could be contracts that were at minimum $10 million, nothing small, right? Second, the procurement professionals or CFOs not really understanding the supplier diversity ecosystem and how to engage diverse suppliers in that ecosystem. And the third was the diverse businesses on the other side of the supply chain, not really understanding the timeline and process to engage the large corporation, right? So I wanted to synthesize those 3, but sort of sub bullets, things like, hey, are you certified? What certification? And then being misguided or thinking that the supplier needs to get certified, and then from that certification you're going to get business. Not true, right? So those, I think, were the 3.
Repeat that, please, because that's an important point. Repeat that, please.
Yeah, so diverse suppliers sometimes have been misguided, and sometimes even still to this day think that when they get the certification that it's going to suddenly open doors to a plethora of opportunities. It's like getting a degree. The opportunity is not waiting for you. It's like getting a gym membership. You are not going to look like Arnold Schwarzenegger because you signed up for a membership. Doesn't work that way. Even if you buy the supplements, it just means you have to do the work, right?
Right.
But there's no blueprint to what the work is.
Right.
That's the hurdle.
That's an excellent point. There is no blueprint, because every business is different. Every, where they are is different. Leadership is different. How organized they are is different. But I will tell you that in my experience, a lot of companies, even companies, I was having a conversation recently, let's say within the last 6 months. And this was with a company that's fairly successful. They do a lot of work for very large companies in the IT space. They have very large clients here in the Philadelphia area. They have very large clients in other parts of the country. Yet and still, I actually have two examples. Yet and still, they are having a challenge getting the amount of capital that they need to grow, right? so that they can take advantage of the opportunities that actually have been provided to them because of their track record. So that's one case, recent case. The other one is I have another client, again, very successful, this time in the staffing business, who has to work for with a factor to get their financing on these contracts. So I guess the question is, what, when you have these companies that have track record, history, good clients, good receivables, what else could be preventing them from getting the stuff that they need to be able to grow their business and be more impactful in their marketplace?
Sorry for the long breath, but that was
you here? You are here to tell the truth, man.
Yeah.
You are here to tell the truth. As much as you can.
Yes, sir. I do a good job, I think, it being politically correct and clear to the audience. The hurdles to, so you talked about the factoring, right? Why would a company have to go to factoring? Some of those reasons are because they grew very fast and they didn't have the equity or the cash to back their growth, right? Entrepreneurs take risk. If there's an opportunity, they want to eat, they jump on that opportunity and they'll figure out how to finance it later, right? You cannot tell an entrepreneur how to act differently.
Absolutely.
Right? The difference is we minorities, Black and brown folks, didn't receive the 40 acres and a mule after Reconstruction, right? And then we had redlining when, blank flight occurred and the suburbs were built, right? And after the Federal Housing Administration, sort of made amends for that and created FHA loans and so forth, right? But those people who were afforded the opportunities to buy homes, create wealth, their homes increased in value, either do a home equity loan if they could, right? Because before, I think 1974, women couldn't get loans.
Yes.
Just women in general.
Yes, they just couldn't. They just couldn't get a loan without a male cosigner.
Without a male cosigner,
That's
right? Just women in general, right?
That's right.
So that's a big problem. And then, if you are Black or brown or Hispanic, you really had a problem, right? You couldn't get a loan because, there were just laws that just denied you from doing so. So fast forward past the 40s, 50s, 60s, 70s, 80s, right? In the 80s, the rates were super high, right? All of that wealth through decades was not being built, was not being passed on. People didn't have life insurance. Folks were dying. They had burial insurance, maybe, right? And you get to 2023, and it could be 4 or 5 generations later. They're smarter, they have education, but they don't have the historical wealth, right? No one, there weren't generations of folk who passed away and they had millions of dollars of life insurance and estate plans, and that wealth was passed on, and now they were able to start a business. Okay, they're smarter, but they have student loan debt, $200,000-300,000, especially if you went to law school, right? Or you were MD or something like that. And yes, some people go to law school or med school or undergrad and they go full scholarship. Not often, right? So yeah, or if you do all that, and let's just say you have no debt, great. You know where you start from? Par. That's where you start, right? You don't start at below par, right? You just start at par. That's where you start at. Right? You just start at par. Zero. That's it.
Yeah.
Right? That's it.
Yeah.
You don't get a hand, right? No handicap, nothing. You just start at par. And then You have to grow from there, right? You don't have the aunt, the uncle, and again, nothing against other families who have those things. What I am saying in this context is Black and brown folk, because of slavery, because of institutional racism, because of barriers to not being in the position to acquire wealth through land and home ownership and getting access to credit. The American economy, capitalism, is built on credit. And if you cannot get access to it or have not gotten access to it, and utilizing debt and how to float debt and things of that nature and do arbitrage and so forth so that you can grow your wealth, when you start a business, you let's just say you were fortunate enough to raise 50,000, 100,000, 200,000, $500,000. Okay. You grow your business to $2 or $3 million a year. You now want to go bid on this $10 million contract. But typically a purchasing director, manager, they're not going to even, I'm just going to say, allow you to win a contract that's more than 50% of your revenues. And or if you are their major client, right? You could be at 2.5 million, but if that's, let's call it 4 clients, and of those 4 clients, one is 50% of your revenue, that's risk, right? That's very risky. And then this new client or prospective client that you want to bid on, win this contract, this $10 million contract will take your business, let's call it 10 million over a 5-year period, right? So $2 million a year. That takes your business now from 2.5 million a year to 4.5 million a year. However, you need to finance that. And typically these purchasing directors, managers, CFOs, they want to see that you have the capital to support the contract. Whether it's a professional services contract, whether you have tangible goods that you have to deliver.
And for those who don't understand what the issue is, an investor, a bank, financial institution wants to be sure that, or a client in this case, wants to be sure that you have the wherewithal to be able to, if you have a professional service contract, to be able to pay your employees on a regular basis. Or if you are selling, as I'm very familiar with, commercial furniture, they want to make sure that you have the wherewithal to front the costs of purchasing the furniture, because they're not going to give up, a 50%, deposit on the purchase, stuff like that. The old adage, it takes money to make money. You may be the smartest person with the greatest idea ever known, but you have to have money to be able to make it happen, right?
100%, 100%. And were you finished your comment there before?
Yeah, I was.
Okay, so you're absolutely right there. You need money. One of the points I wanted to make, Mike, is that I think the audience should know that when you're in business, you should follow the money, and you're in the business of managing money, right? So I will relate that to banking.
I love that.
Right, I will relate it to banking, but then I'll relate it to, let's call it, the furniture industry,
right?
And then some other industries. So in banking, people ask me, "Oh, what are you doing?" And I just kind of blankets, I'll give a blank statement and say, "I'm a banker," and it gives people an idea. Well, what do you do? I say, I sell money. They say, "What? You sell money?" I'm like, "Yeah, that's what banks do. They sell money. They just need you to figure out what product you need in order to sell you money. So therefore, they have products." A credit card, they're selling you money, but they're giving you a card, right? You just have to qualify. A home. Oh, there's a product. You want this home? I can sell you some money so you can buy this home. Okay, cool. You want a car? That's a product. I can sell you some money so you can buy this car.
You can buy that car.
Right. So lend. They're selling you the money, right? Say, because you got to pay it back.
You got to pay it back.
Right? You got to pay it back. Right. So that when you relate it to, let's call it furniture, right? You win a multi-million-dollar contract. It feels good. That large company that says, hey, we want you, let's call it, one of the largest companies around, I'm not going to name names, but the ABC company, they're a Fortune 100 company, and they just, opened a new building in the city of Philadelphia, and they want you to, furnish it. Well, in essence, you're financing the furniture outfit of that business.
That's
not
correct.
them.
That's correct.
So you have to manage the finances, i.e., the cash flow, the timeliness of the furniture being delivered. That is now on your balance sheet, your income statement. You just need to deliver, and the cost is now passed on to you. However, because it's passed on to you, you get to charge a fee.
Yes.
And mark it up a little bit.
Yes.
Right. And
everybody's marking up. See, that's the whole thing about all of this.
Yes.
Everybody's marking up.
Right. So because it's passed on, you get to charge this fee for your convenience.
Right.
Of doing the work that they don't want to do.
Right.
Not that they don't want to do it, but it's not in their core competency.
Right. Right.
Right. So in essence, you're managing money because they want a product. They're going to yield to you, your team, the expertise. They say, hey, come in. You show them the kinds of product you have. You look at the design, the architecture, the layout. You even maybe help them with that if there's some issues and challenges. You look at, the people, ask if they have any health issues regarding ergonomics. Do they want to stand, sit? So
listen to you.
I've been in the industry. I know a little something, right? So you kind of get to learn all these things, but you also might want to say, okay, do you have other furniture? Because then there could be an asset management play, right, with that. So then you begin to add value, right? So I'll stop there, because if we don't have the wealth to finance that $10 million project, and it happens pretty quickly, then you have to go to factoring. A solution would be to look for asset-based lending or accounts receivable financing. Asset-based lending is typically if you are producing a thing. So you're not producing a thing, you have to deliver a thing. So then you would be looking for accounts receivable financing or contract financing. I'd like to finance, as a business, this specific contract for the duration. It could be 6 months, 12 months, 18 months. As long as you know what your margins are, you can do a cash flow analysis with some projections and include the debt service in those projections to understand your profit margins, to determine if the cost of capital is worth it.
Let me ask you a real quick question, because it just popped into my head. So if you are, and we just talked a little bit about your industry and how a lot of growth in your industry, and just like any industry really, is done by acquisition. How does, if my business is Joe's Widgets, and Joe's Widgets is the dominant player here in Philadelphia, but there is an opportunity for Joe's Widgets to acquire a business down in Delaware to grow its footprint. How does Joe's Widgets go about financing that acquisition?
Great question. Thank you so much. So a financier, let's call it a bank, if they want to use debt to finance it, I want to speak from a debt perspective.
Yeah.
Joe's Widgets could essentially, when they begin the due diligence process and sign, kind of their letter of intent. So first, Joe's Widgets are going to, they're going to approach that company. They're going to understand what they're selling it for. And then Joe's Widgets has to have a team together to understand if that valuation is real. And that will take reviewing financial statements, if that company has financial statements.
And when we say that valuation, you mean the valuation of the company to be potentially acquired, correct?
To be potentially acquired in Delaware, right? So let's, and I'll put a number on it. Let's just say, Joe's Widgets would like to acquire Jack's Widgets Plus in Delaware. And Jack's Widgets Plus is valued at $20 million, right? And Joe and his team must figure out if that $20 million valuation for Jack's Widgets Plus is real. First, is it market standard, right? So they'll look at the revenues, expenses, net profitability over the last 3 years. And because there was a pandemic, now we need to look at the next 5 years, because those 2 years, they were outliers. So what did Jack's Plus Widgets look like during regular times, right? And, you know, that anomaly, those 2 years that were anomalies, did things go up, down? How did they manage? Did people stay, leave? What did the
I would be
clientele?
responsible though for, I would be responsible for getting the valuation done, correct? The bank wouldn't be responsible, or would the bank take charge of that, because it would be the bank looking at potentially helping to finance the deal?
Yeah, I'll synthesize it. The bank will get the valuation,
Okay.
right? Because the bank will have approved vendors that they use, very reputable firms that will do the valuation that they can trust and rely on, right? And so, but the bank will work with Joe's Widgets to say, hey, here are the companies that we recommend to do the valuation. So you have a say, and you know who they are, right? And we'll say, all right, we'll pick this firm. They'll go out, they'll do the valuation. It's a valuation we can trust. Now, I've been in deals that, you know, companies have gotten their own valuation. They've come to me and said, we've gotten a valuation. I'm like, okay, that's nice. We still have to get one, right? Because we don't know what's in your numbers. We can't trust it, right? So we go with trusted vendors that will do a valuation, and, you know, we'll do different types of valuations to show different scenarios. Discounted cash flow valuation, right? We'll do you know, EBITDA, earnings adjusted valuations. So there's different adjustments, and then they'll do an average of 2 or 3, you know, market rate valuations, or, you know, NOI, so net operations times 3.
So they'll have multiple methodologies that they use in their valuations.
Yes.
And then they average them out.
It depends on the industry. Like if it's professional services, right? Because you want to look at those different valuations to make sure they're not too far off, right? Because they show you different scenarios and things of that nature. Typically, they just pick one, right? Typically, it's just one, and you kind of go with that one that's standard for that industry. If it's like an engineering company and they're doing something, you know, funky, like an ESOP or something like that, they'll look at different ones. So yes, the financing organization will do the valuation. You can finance it. The quick and simple answer is you can use leverage. Leverage is debt. And you can use leverage based on the cash flow of Jack's Widgets Plus, not Joe's.
Right.
We'll look at Joe's to see how Joe is doing.
Right.
Right. But we want to make sure Joe and his company is not, you know, on the brink of failure, and they need the money from this company so that they can do well. Right. Because that could be a recipe for failure. Right. So we will do a cash flow analysis. We will do, you know, ratios and an evaluation on Joe's company to understand how Joe has managed his business. Right. Because if Joe and his team has historically done a good job, we know that this acquisition is worthy for Joe. Got it. But if not, I don't care if it cash flows or not. Joe doesn't know how to manage business. So no, we don't want to help you finance it, because you're going to buy this thing and it's not going to look good, because historically you're not managing your business. And we also look at your people, right? Team and things. So it's a very detailed process, but optimally you can do it through leverage. You can also do it through equity. You know, when you think about, so making a capital stack, right? You can have your debt, you can have equity, of course, owner's equity, things of that nature, and different pieces of financing that is a part of the capital stack.
So one last question, and then we're going to get to the second section, the rapid fire questions. What would you tell? So you made reference to, you know, coming out of college, you know, you had played football, but by the time you got out, you had a kid, you had a 3-year-old, which is like, God bless you, man, because Lord knows That was a lot. But, you know, put yourself in that position again. What would you tell a young person coming out of college, or a couple of years out? They have an idea, they think they want to start a business. They don't like really working for other people. They have a great idea. They want to kind of run with it, whatever. What should they be thinking about if they're thinking about starting a business? What are the main kind of factors or issues they should really be hashing through before they start a business?
I want to say just get started, right? That's
Okay.
what I want to say. So I'm going to say that.
Okay.
Right. You and I, all this education, it sort of stumps you and you like overthink things.
You got that right. Now, that's the truth. That's
right?
true.
Yeah,
that's true.
All this smart stuff, like, nah, just do it.
That's true.
Right? Now, I'll give you, the audience, some context behind just do it. You need to have a team. You need to understand your unique value proposition or unique selling proposition to the marketplace. You need to understand if there's an opportunity for your product or service that you want to deliver to the marketplace, and what is the need for what you want to sell. And then if there's a need, where is it? Right? What is it in an age demographic? Is it in a geographic location? Right? How can you target that niche group of people that you want to sell to optimally? So you need to know those things, and you can't spend a whole bunch of time figuring that out or researching. But if you, using sort of the technology lean startup wording, you use your MVP, minimum valuable product, the least amount of cost, least amount of time to develop a prototype product and deliver it to the marketplace, get feedback from the marketplace, iterate, change, update, redistribute, get more feedback, iterate, change, update, redistribute, get more feedback, change, update. Most people think of it as, oh, damn, I failed, I'm done. But
that's what trial and error is all about. I mean,
yeah,
that's essentially what we're talking about, right?
Yeah. So in the technology world, right,
that's what they do.
Right. When you say, iterate, get feedback, you don't say trial and error because it sounds negative, but it is trial and error. In the pharmaceutical space or the science or the STEM space, they call it R&D, research and development. And there are trial periods. They don't use the word error, right? They use efficacy.
Yes.
Right. Or efficiency or usage and things of that nature, or trial period. And once the trial period, once the level of sort of error in that trial period decreases to a certain percentage that's acceptable, then they release it to the marketplace. Right. But they take it through a whole bunch of those. And just now, I'll give you an example. Years ago, we have seen this weird company, this company come out with this weird can, and they would just deliver it to people. They would be standing on corners in very highly populated areas, maybe downtown in many towns. And they called it an energy drink, right? It had an odd name, and it was 8-ounce can, 12-ounce can, oddly shaped, right? For positioning in supermarkets, right? This was Red Bull. And all of this was a pilot. They iterate, got feedback, iterate. They gave it to people. People wanted more of it.
I remember when they were giving that out in the streets.
Yes, sir. Yeah.
I remember that.
Yeah. And what occurred is that they started creating demand for their product, right? Because they started giving it away and they started sponsoring things, right? So a lot of money went out, but then that demand, that information went back to their funders so they could say, now there's a demand. We need shelf space, and we need good shelf space. And because of the size of our cans, now you have to adjust it. So actually, we'll create our own shelf space. Remember when you went in the stores, they had their own sort of box setups or these little coolers in the stores. So they had their own space until they can get into the freezer. But before that, they literally delivered their own. Right. Because they were creating demand for their product, which essentially created an entirely new marketplace. It wasn't coffee. It was the energy drink space. And now that energy drink space has grown, much like Netflix disrupted the movie viewing space,
right?
Because Blockbuster Video said, hey, brick and mortar is where it is. Netflix said, no, streaming. So essentially, they took the pie.
They had an opportunity, we got to get to this next section, but Netflix, Blockbuster actually had the opportunity at one point to purchase Netflix.
Yep.
And didn't do it.
They didn't do it.
And they didn't do it.
That's correct.
Second section here, really quickly, because I know we're running up against it. Rapid fire questions, my friend. These are questions that really, although I think the audience is really going to get a sense of you just through the conversation we've just had, it just gives them a little bit more. So, are you ready?
Yes, sir.
All right. One word that describes you.
Outlier.
Oh, okay. The best piece of advice you ever received.
Invest in yourself.
Love it. Talent that you have that most people don't know that you have.
Resilient.
What?
I am resilient.
Oh, you are resilient. That is your talent. Okay.
That's a talent.
Okay. I got it.
Well, actually, I want to redo that one. So I like resilience. However, I have a talent that most people don't know I have, and they misunderstand it. And that's a talent to engage and connect with people.
Oh, I thought you were telling me you were about to say you could sing or something.
Negative. and if I can give an example, I can, but I'll ask that before I go because I know we're up against time.
What do you consider to be your biggest success?
That's a tough one. That's a tough one. I have a couple of them.
Okay.
I would say being dad. Yeah, biggest success, right?
Mm-hmm.
It's my biggest success because I didn't have really good examples of that growing up. And I was very, as a young person, scared and even didn't want to do that because I didn't think I was going to be good at it because I didn't see or experience great fatherhood, fathership. I just did not.
Right.
And so my chief aim as a young person, I told you, my son was born when I was in college. It was just to be a really good dad. So I have a 26-year-old son and a 20-year-old daughter, and now a 2-year-old granddaughter and a 25-year-old daughter-in-law. So bigger family, been married for 20 years. So
that's awesome. What book has had the biggest impact on you?
That's a good question. I'm sitting there staring at my bookshelf. I read a lot of books. The one that has the biggest impact on me. I would say Think and Grow Rich by Napoleon Hill. Okay. Yeah, but also, there's another version, Think and Grow Rich, A Black Choice by Dennis Kimbrough. So it's a companion book that was approved by the Napoleon Hill Foundation and Napoleon Hill for Dr. Dennis Kimbrough to write. So that got me on the wealth building journey and the understanding life a little differently.
Finally, and by the way, the whole wealth building thing, it's interesting to talk about it. I talk about it a lot as well. Wealth, the word wealth, I think can be off-putting to people for whatever reason. But really it is, how do you grow your assets so that you can be more free and so that your family can be more free?
I'm a co-sign that.
I mean, that's really what you're talking about, right?
Yes, sir.
When you have been in this country for so many years and we were literally in bondage. And then, you talked a little bit about the history. Just systemically, we stayed in some type of bondage where we did not have the ability to generate opportunity and freedom for ourselves, right? Or it was very challenging. I mean, we Some of us did, right? Some of
Right.
us were able to, but most of us were not. And so as we think about this kind of concept of wealth, it's really about how do we continue to work to free ourselves and to free the others around us, and ultimately to free our community, so that we are able to get better education, so that we are able to live in safe environments without risk of, some kind of physical violence. It all comes together. And so the work that you're doing, even on an informal basis, is really helping that process for us to continue to go through. And it's going to take, I don't know how long it'll take, but in terms of the stuff that you do, it's extremely important. And the advice that you give is extremely important to continuing to create these opportunities for freedom.
Yeah, I
Right.
appreciate that. I totally agree. So, not only do I do or am I or work as a commercial lender for a community bank, but I also sit on, economic development boards, one in Philadelphia, one in Montgomery County, which is an authority, and I also chair economic oversight committees for large construction projects in the city of Philadelphia where there are wealth building opportunities, right?
Mm-hmm.
I'm talking billions of dollars being moved.
Mm-hmm.
And so the way that I um, deliver on my value proposition regarding wealth creation is having, one, access to capital in various forms, equity and debt, as well as access to wealth building opportunities, i.e. contract opportunities,
Mm-hmm.
prior to them being bid out, right? As well as existing, or what they call shovel ready, right? Or bid ready projects. And so that's tangible and real.
James Sanders, thank you so much for being a part of our show today. We so appreciate it. Really, it was better than I thought, and I thought it was going to be fantastic. So there you go. And to our audience, thank you as well for being a part of our show today. We look forward to continuing this discussion and keeping it going. Until the next time, take care.